Good afternoon and welcome to our webinar. My name is Peter Dachs and I'll be the moderator of the session today. Let me start by introducing my fellow panelists who you will see on your screens. So we have Derushka Chetty, who's an executive in the South African Competition Law Department. We've got Mmangaliso Nzimande, who's an executive in the South African Tax Department. We've got Fenyane, who's an executive in the South African Corporate Commercial Department. We've got Celia Becker, who's the head of our African Tax Desk. And we've got Muthee, who's a tax executive in our Kenyan office, and who also advises on tax issues throughout Eastern Africa. So we had a chat and we've decided to keep the session very practical. So no long lectures on boring legal stuff. In fact, we've developed a case study, which we're going to unpack using our combined expertise on the panel. So what is our case study? We have got a multinational group in the hotel and leisure industry, which is based outside of Africa. and they want to acquire an existing restaurant chain and set up a new line of hotels in various African jurisdictions. And they want advice on, unsurprisingly, the competition law, corporate law, and tax law implications of their expansion. We're going to divide it up into two sessions, two parts. The first part, we're going to go in country. So we're going to ask our expert panelists for their input on the relevant issues arising in their particular jurisdictions where they practice. And then we're going to go to the management of the whole project from an African perspective. So starting off in country, Derushka, can you kick us off and tell us about the relevant South African competition law issues, please?
Thank you, Peter. Good afternoon, everyone, and thank you so much for joining. In a cross-border M&A transaction, much depends on the detail, and there are always a number of moving parts. There are always aspects that you're able to foresee from a competition law perspective, and those, of course, that you can't, and you've got to be reactive, understandably so, in a regulatory space. If I have to choose two factors to talk about for the segment that contribute to seamless cross-border transactions, especially having regard to the case study, it would be, from my perspective, to try and get as much of a sense as possible on the following. The one is a screening exercise on, do we need competition law merger approval? And that, Peter, is in South Africa, but also across the continent as well. And if so, and you do need approval, for what aspect of the deal? Is it the acquisition of the restaurant chain? Is it the expansion? Is it establishing a new business from scratch? And then the second part, I would say, is what issues could arise for the deal in each country, as best as we can foresee it with the facts at our disposal. And so understanding the competition regimes that you have to deal with as early on as possible, as reasonably possible in an M&A transaction, could influence all manner of things, including the commercial negotiations between the parties, pricing of the deal, long stop dates, taking into account all the CPs, but also getting a sense of the kind of resources you need to devote to the deal. Because if you have two or more filings to competition regulators running concurrently, and some deals have as many as 10 or even more, there are a number of balls in the air that you need to manage. So when it comes to deal structure and aspects of a deal that may or may not need competition law notification, as a textbook statement, I would say to this group that competition authorities are generally interested in acquisitions of control over the whole or part of a business. So simply put, depending on the regime, establishing a new hotel business from scratch ought not, strictly speaking, to trigger a merger notification requirement. So in the case study, my focus is really on acquiring the existing restaurant chain, which is a business, has revenue, has assets, has a market share in a particular sector. And I will assume that establishing a new hotel business from scratch would not require any competition law merger approval. But there are also caveats I want to leave the audience with, because of course, in the real world with complexities associated with transactions, if there are preceding transactions to establishing a new business, for example, in the hotel space, if you're going to be acquiring tracts and tracts of land or buildings, you would need to actually assess, are those mini pre-transactions notifiable? Do they in and of themselves require merger notifications? And I'll sort of leave that there for the time being. So bringing it back to acquiring a restaurant chain across Africa, when you look at a screening exercise for competition law purposes, it bears mention that in South Africa, as we all know, it has its own regime, but most of the countries on the continent as well also have their own regimes as well. So some have their own regimes, some are part of regional regimes, and some have a combination of the two, which require navigation. When it comes to screening and taking into account thresholds and requirements, I'll give a couple of examples just to give you a flavor of what you need to look at. In South Africa, you've got to look at, as I've mentioned, are you acquiring control of a business? And are the financial thresholds met? If so, you would trigger an obligation to notify the South African Competition Commission of the restaurant chain acquisition. And our regime in South Africa is suspensory, which means you cannot implement the transaction without getting approval from the South African Competition Commission. There are, of course, different categories of notifiable mergers, and they have different processes, different timelines. And of course, even if the thresholds are not met, there are guidelines to be mindful of. But roughly speaking, if you're a notifiable territory in South Africa, the following thresholds would need to be met for the previous year. For an intermediate merger, and this is the category where the Competition Commission is the final arbiter, it has a maximum period of 60 business days and 60 business days only to investigate and make a decision. The following values would need to be met. On the one hand, the restaurant chain alone must have gross consolidated assets or revenue, whichever is higher, of 100 million rand or more. So that's the magic number, 100 million rand for the restaurant chain. And then you move on to the second leg, which is, well, what does the purchaser have together with the restaurant chain? Does the value combined exceed or equal to 600 million? And if you meet those two values, you're an intermediate merger territory. For a large merger, and this is one where the commission investigates, refers the matter to the tribunal, and then you have a hearing, and there's unfortunately, no finite investigation period. The numbers there are 190 million rand for the restaurant chain alone, and the combined value taking into account the purchaser and the restaurant chain is 6.6 billion. So just some important points. It doesn't matter if the acquirer is an offshore or foreign entrant with no activities in South Africa. Depending on the value of the restaurant chain, the target can technically meet both legs of the thresholds on its own. And so even though a transaction may involve new entry into the country, when you're assessing thresholds, you have to calculate the entire acquiring group's assets or turnover into or from the country. So even though a foreign acquiring vehicle may not, in that division, have any activities in South Africa, you really have to look all the way up the structure to the ultimate controller and all controlled interests of the entire group when you are calculating thresholds. And of course, I know, Peter, you asked about South Africa as well from a competition law perspective, and we'll touch more in the second segment, just to give a flavor of how, yes, there are universal elements to competition law principles, but each regime does have its own different requirements. So I'll take very quickly Eswatini, which is also a suspensory regime. But if you're doing a deal where there are activities in COMESA, which I'll touch on in a second, Eswatini and South Africa, you have to assess all the different regimes. Eswatini doesn't have any financial thresholds. So technically, any acquisition of control over a business there could trigger an obligation to file. If you look at COMESA, which is the common market for Eastern and Southern Africa, it's a regional regime. It comprises 21 member states. It includes, I won't go into all of them, but Egypt, Kenya, Eswatini, Uganda, Zambia, and Zimbabwe. COMESA is currently not suspensory. So at this point in time, you technically don't need to wait for COMESA approval before you can implement there, provided you notify the transaction within 30 days of the parties' decision to merge. That, unfortunately for parties, will soon come to an end because there are moves in COMESA to change that to a suspensory regime in 2024. Very quickly for COMESA, you have to look at acquiring vehicles and target firms, and are they active in 2 or more member states across the common market? And if so, the magic numbers there are, on the one hand, all parties cumulatively have to have asset or turnover values of $50 million US, and the target alone, which would be the restaurant chain in this situation, would need to have across the common market an asset or revenue value of $10 million US. From a COMESA perspective, if a transaction meets broadly the regional COMESA requirement, but also an individual member state requirement, you are able to use COMESA as a one-stop shop. But it's important to take advice on a case-by-case basis at different times, because sometimes things change. At the moment, there are some countries and member states that still require separate written confirmation or separate engagement about ongoing, about filings that are made. So it's very important to keep on top of developments which are in a state of flux from time to time. So once you've done your screening and you know where you need to notify, I think for me, the second important factor is, well, what do they require from you? And could we face some issues in that jurisdiction? And in South Africa, apart from pure competition issues, our competition authority looks at, well, what's the impact on public interest? And so in a scenario where you have a foreign entrant coming into the country, acquiring a restaurant chain, and you assume that vehicle, the acquirer, doesn't have any activities, it's a brand new entrant, there shouldn't be any competition issues, there's no overlap, there's none of that type of consideration. You then are still left with the public interest considerations. And especially when you're dealing with foreign entry coming into South Africa, you really need to look at and take advice on, well, what's happening on employment, for example. Are there going to be any retrenchments? Does the new purchaser plan on retrenching employees? And if so, you would need to justify this to the Commission. Importantly as well, in the food sector, which is a priority sector for many regimes, you have to look at, does the current business have any local contracts with small, medium businesses, historically disadvantaged persons? Are you going to continue with those agreements? And those are the types of issues that would need to be looked at, including the promotion of a greater spread of ownership. There's a draft public interest guideline in South Africa doing the rounds, the legal fraternity. It is a critical time for us as we want, to get more certainty when it comes to how is our Commission looking at public interest obligations, in particular, the obligation to promote a greater spread of ownership, because the Commission in many deals has been asking for commitments to bring in a local Black partner, establish an ESOP, a share ownership program for employees. So we're in a state of development at the moment. And so I would say very important for factual cases to take advice and to be aware of, well, what would you need to do? Would you need to give any commitments for your transaction? And just my last point would be to say other regimes on the continent also have public interest considerations. So when you're doing your assessment, it's not only about South Africa, what are the local issues on the ground in each country where you need to notify? Thanks, Peter.
Thanks, Derushka. That was really clear. And we're going to come back to you later about the rest of Africa. One obvious point is that rand number that you mentioned, that sort of hard number, obviously in hard currencies changes all the time. And in the last year, that would have come down significantly in terms of dollars and euros and pounds, etc. So, just a sort of an observation, especially given our volatile currency. Isaac, can you talk to us about the corporate commercial issues in South Africa?
Yes, certainly. Thank you, Peter. I think what will be of importance for our client to just take note of is that, unlike many other jurisdictions in the world, USA included, we don't have very restrictive screening process for foreign investment, as the US has through FEMA and CFIUS. So our foreign investment climate is very much receptive to investment, and we do have a promotion and protection of investment through which we assure investors of protection, particularly on issues such as property. So they are assured that they will always be treated on equal footing as with local investors. And with that also, considering that we are dealing with a hotel business, the issues of land tenure are important. And in South Africa, we do not have foreign investment restrictions, again, in the context of land ownership, as it happens with other African states, where foreigners are not permitted to own land, or where their land tenure may be restricted to leases for a specific period. So we do not have those types of restrictions. Again, they're just, it's worth mentioning. The other aspect is in relation to share ownership. Again, we do not have restrictions insofar as foreigners are concerned. So our client in this case can pretty much acquire the target and be 100% shareholder if they so wish. The only thing to note, however, Peter, is that there is a requirement for Black economic empowerment. It's not a strict requirement as in like being obliged, but it is structured in a way that to be competitive, foreign investors have to keep in mind that they may have to partner with local empowerment partners to ensure that they reach the requisite level to compete for public procurement and private procurement, particularly in the hotel space, where key part of the business would obviously come from the public sector, including also the private sector. Your companies that may want to ensure that they are procuring hotel accommodation from suppliers who are at a particular level of empowerment. So that's something also for mentioning as a preliminary consideration. And if our client is a multinational and they are not generally inclined to be admitting partners or to be going into these types of transactions with partners, and that is a general requirement that applies throughout where they have operations, then the mitigation of the empowerment requirements may be in a form of what is called equity equivalent investments, which allow those types of multinationals to structure an arrangement through which they can earn similar points as they would earn under the traditional empowerment structure for ownership. So that's one other thing to mention on the ownership point. Insofar as regulators are concerned, we do not have a dedicated regulatory body that would have oversight on this type of transaction in a sense that they would have to approve the transaction before it can go ahead. However, depending on the nature of the target, if the target, for instance, is a public company, there may be a need to engage with the takeover regulatory panel, which will have to give a green light for the deal to go ahead. And if the target is listed, again, there you are in a territory where you may have to comply with the listings requirements of the exchange where that target securities are listed. And that, in the context of JSE, may mean that if it's at a particular level of materiality, there may be a need to get shareholder approval. That is in the case of what is called Category 1 transactions. And if it's at a lesser level, it may not necessarily require the approval of the shareholders of that target, but it will still have to be publicized to the general shareholders. So I think those are the items that one need to just keep in mind. I will later on touch on the other jurisdictions, Peter, when we deal with how we manage the transaction.
Thanks, Isaac. It's really interesting. And I think fair to say that South Africa is a fairly investor-friendly jurisdiction from a corporate commercial perspective, as you sort of allude to, with some restrictions around, as you say, particularly in the listed space. But, I think it's, sounded pretty positive. If I'm the CEO of this multinational group, I wouldn't be thinking I'm staying away from South Africa. So that was really interesting. Thanks, Isaac. And Mmangaliso, I know you do a lot of work for inbound investors from a tax perspective and lots of due diligences and lots of advice. Can you tell us a bit about the South African tax issues our client would need to think about?
Thanks, Peter. Thanks, everyone. Peter, there's a number of issues or tax issues, but what I will do is just touch on a few that I think are important and based on what we're seeing in the market as well in terms of the transactions, and also just share some insights as well based on our experience. I think when it comes to transactions like this, inbound investments, the first question is always, well, the purchaser is interested in the business, the seller wants to sell their shares, they want a clean exit, and then there's that sort of struggle in terms of which option should we go with. But in terms of the deals, in most deals, it will be the sale of the shares. So the sellers are always reluctant to just sell the business because they want a clean exit. So in terms of what we see in terms of the critical tax issues, I think when it comes to finding one has to take into account the interest limitation rules in terms of Section 23M. I think that becomes critical if there's going to be funding coming from the US to the South African group or the chain or the newly established hotel group. So that is quite important to take into account, and the interplay between Section 23M and Section 31, which relates to transfer pricing. So that is one issue that I wanted to raise. And then secondly, it's also important to just consider whether in this context, in the context of the acquisition of the restaurant chain, whether there have previously been any group restructures, which might then lead to degrouping charges when the acquisition is done. So I think that's an important point to consider as well. And also then to consider on both instances on the acquisition of the restaurant chain and also in respect of the hotel, of the new hotel group, whether there were any capital allowances that had been claimed, especially in respect of the hotel, the restaurant chain, and also to consider whether there were any allowances that would be applicable in the hotel business in relation to the buildings as well. So that's quite important. And I think another, just to share some insight, another issue that we often come across in this type of inbound transactions by multinationals is the issue of share incentive schemes. And you really need to consider that, and you really need to consider the tax treatment of payments that might be made to existing management. And if I can just share some insight on a matter that we had a few years back, where the share incentive scheme, the proceeds from there had been structured in the way that they had been structured out of Section 8C, but when we had a look at it, when we did the due diligence and we're doing the structuring, we were a bit concerned about that. But because it was a transaction that was done in a context of a competitive bid, our client didn't really have much say in terms of how the transaction should be structured, because it was a bidding process. So what happened there is that, and I think this is quite an important thing, is that we then advised that tax liability insurance be utilized so that the risk that had been identified doesn't become a deal breaker. So we're seeing an increasing usage of tax liability insurance in M&A transactions to cover that risk where the parties do not necessarily agree whether it is a risk, and where the sellers are now not willing to give any warranties or indemnities. So it's becoming a very useful tool within M&A transactions. And also, I think what I've said needs to be considered in the context that it becomes critical that a proper due diligence exercise, tax due diligence exercise, is done by the seller to identify all the tax risks that might possibly arise from the transaction. And it's also what we've noticed as well is that warranties and indemnities insurers, they also consider the transaction, and they identify issues and ask that those issues, that a deep dive DD be done on these issues before they can cover them as well. So it becomes critical to do a full scope DD, but obviously in some instances the clients will ask that a high level red flag text DD be done, and which is also fine because it also identifies some issue. It might not be as detailed as a full scope, but it also assists in the transaction as well. And then if I can also touch on the issue that we see in transactions, especially where a foreign group is acquiring a business from another foreign company, is exchange control. Because what we often see is that previously a foreign group had come in, acquired a South African entity, but no exchange control approval had been sought, and the share certificates had not been endorsed non-resident as required by the exchange control regulations, and that can throw a spanner in terms of the finalization and closing of the deal. Because what it means then is that you need to go back to the authorized dealer, and which then needs to apply to the Reserve Bank for basically for regularization of the transgression and the endorsement of that share certificate. So it becomes quite critical to take into account all the key tax issues, do a proper tax due diligence as well, and also take into account exchange control as well.
Thanks, Mmangaliso. And just on exchange control, because exchange control does not apply to non-residents. So that's the starting point. And I think that is true, and that's useful to know. But once you, as a non-resident, have acquired South African entities, then exchange control kind of indirectly does apply to you. You know, for example, for South African subsidiary now, this new restaurant chain that you've acquired, they are South African residents, you know, so they are subject to exchange control. And you can't, for example, go and buy the intellectual property from those entities and externalize them to your jurisdiction, because you've almost bought into the exchange control net through coming into South Africa and acquiring subsidiaries here. So I think that's quite important to note. And as you say, just practical issues around if the previous non-resident holders of the shares haven't had them properly endorsed, etc., you pick up that problem. So I think, you know, exchange control, I think, Mmangaliso, thanks for raising that, because I think it's a really important issue in respect of all cross-border transactions. And then due diligence, as you say, you know, we do high-level ones, we do detailed ones. And I think they typically go for 3 years because that's our statute of limitations effectively. I think we normally do three years, sometimes a bit longer.
Yeah, so it'll be 3 years for income tax, 5 years for VAT, and 5 years for employee tax.
And that's because that's our statute of limitations. But of course, that statute of limitations doesn't apply if the business has not disclosed material facts to the South African Revenue Service. So you're taking a bit of a chance, even going back only 3 years. So there are tax traps, you know, inherent in buying into existing entities, I think.
Yeah, so if the revenue authority starts in this instance is of the view that there has been non-disclosure, misrepresentation, or fraud, then they are not bound by the statute of limitation. They can go back as far as they want. So there are those risks, and it makes it very critical that you do a proper tax due diligence exercise before deciding on that investment.
100%. Thanks, Mmangaliso. George, let's move away from South Africa. Can you talk to us about Kenya and East Africa in general?
Most certainly. Hi, everyone. So Peter, the expansion into the East Africa region would either be an acquisition or a greenfield setup. If it's an acquisition that's being done of existing hotels in the East Africa region, then consideration would have to be done around, you know, the due diligence that Mmangaliso has spoken about. The statute of limitation in most countries in East Africa is 5 years. So usually a due diligence would be done for a 5 year period to just make sure that all liabilities are being captured. Now, if it's a greenfield project, it's pretty straightforward to set up an entity in either Kenya or Uganda or Tanzania or any of the other, you know, Horn of Africa countries. The first consideration would be, you know, do you want to operate as a branch or subsidiary? from a tax perspective, there's not much differences between a branch and a subsidiary. The headline tax, corporate tax rate is pretty much the same at 30%. The preference, however, is usually for subsidiaries because subsidiary, unlike a branch, gives you that legal ring fencing that you get as a shareholder. Whereas a branch doesn't really give you that sort of comfort. So you tend to see a lot of foreign investors going for company structure. There are no minimum capital requirements in most of the countries. Kenya, Uganda, nil minimum capital requirements. Ethiopia has $200,000 minimum capital requirement for foreign investors. But if it's a business that is being set up between a foreign investor and jointly with a local investor, then the minimum capital requirement is reduced to $150,000. So that's quite significant. Tanzania has about 20,000 Tanzania shillings minimum capital requirement, which is comes to about 10 USD, which is quite nominal. In terms of registration of the entity itself, there are no stamp duty implications in Kenya and Tanzania. There's nominal stamp duty in Ethiopia, which is about $6. Uganda has a 0.5% stamp duty applicable on the nominal value of the capital registered in Uganda. I guess one other thing to highlight on a registration is that if the registration is happening in Ethiopia, then the foreign investor would be required to register the capital that they are bringing into Ethiopia with the National Bank of Ethiopia. This is based on Ethiopia's forex laws. And if the foreign investor fails to do this registration, then it becomes quite difficult for the repatriation of profits in future. So that's just something to take note of. In terms of the operation of a hotel in either one of these countries, the general tax environment is quite comparable to what you find in other countries, South Africa, European countries. Most countries in this region apply the OECD guidance. Yeah, so you've got corporate tax rates, pretty much average at 30%. VAT at rates between 15 to 18%. Transfer pricing is applicable on transactions between related parties. You'll have customs duties applicable on importation of items into these countries. But I guess one thing I would want to speak about is investment incentives that are applicable in these countries over and above, the usual tax depreciation that you get on assets. So if a business is set up in Kenya, there is a regime known as the Special Economic Zone, which provides a reduced corporate income tax rate of 10% for the initial 10 years and 15% for the next 10 years, yeah, in comparison to the usual standard 30%. And beyond the usual tax depreciation, there's a 150% investment deduction that is applicable on investments that are done within a 3-year period of a value exceeding 2 billion Kenya shillings, which is currently about $13 million US. So you get a 50% deduction over and above the value of your investment, which is quite significant. Ethiopia has somewhat similar rules. There are tax holidays of up to 9 years, depending on the sector of investment, and also depending on the location of where the investment is done. So if the investment is done within Addis Ababa and the Oromia region, then you get fewer years. Yeah. Whereas if the investment is done beyond the Addis Ababa and Oromia region, then there are more years of tax holidays. Last year, the Ethiopian government overhauled its investment laws, and a new investment regulations were issued, which sort of give some additional incentives, especially to investors who are looking to invest in the hotel industry. Yeah, so such investors who invest in away from the center, which is Addis Ababa, or in an area that has very low infrastructural development, and they get a deduction of up to 30% on their income tax, and a 5-year income tax exemption if the hotel is star designated and is located in select tourist destinations. So it's quite interesting to just keep that in mind. Now, in terms of an exit, which is a good structure, anticipates a possible exit at some point. It's quite important to remember that most of the countries in this region have rules around indirect disposals. So if you've got the Kenya entity, held by an intermediary holding platform outside Kenya, and a transaction is done at that level, then in certain instances, then you'd have that transaction being subjected to capital gains tax in Kenya. So we've got such provisions applicable where the entity in Kenya is property rich, and at least 20% of the value at the offshore level is derived from movable property in Kenya. Yeah. Similar provisions are there in Ethiopia and Uganda. The threshold is 50% ownership of movable property. And just lastly, in both Uganda and Tanzania, regardless of the ownership of property, if there's a change of control at directly or indirectly, then you do then trigger tax liabilities depending on how that occurs. So by and large, the region is quite popular with the incentives around new investors coming in, and depending on the value and quantum of investment, there's some quite good tax incentives which can be reaped. Yeah, thanks, Peter.
Those are really nice incentives, George. Mmangaliso, we can't compete in terms of incentives. We should have set up the case study for the generation of electricity, because there you get a nice incentive in South Africa, 125% on day one. But I think your incentives there are very powerful, George. And just to clarify on exit, if you're not a property rich company, is there typically capital gains tax, or is it mostly only in respect of property rich companies?
So in some jurisdictions, specifically Uganda and Tanzania, they would have provisions on property rich companies, but they also have provisions on change of control. So if the change of control is triggered, which is a change of 50% or more, then the entity is deemed to have realized its assets at that date. And so then the tax gets triggered. Yeah.
So in South Africa, interesting, because if you exit as a non-resident from a South African entity, then the only time you pay capital gains tax in South Africa is if it's a property rich company, or if you operate through a permanent establishment. So I think they're interesting sort of distinctions. So let's just a bit of housekeeping. There was a question, are we going to share the recording? Yes, we are recording this, and we will send it to everyone who is on who's watching us, and anyone else who wants to see it. And then I see the chat box is filling up, so please put your questions in there, and we'll revert to you, if not on the webinar, then afterwards. So please keep the chats coming or questions coming. Okay, moving swiftly onto our second segment, we're now going to look at managing the transaction across the African continent. And I'm going to ask you to chat to me a little bit about how you would manage this project on a pan-African basis, as opposed to looking only at your own particular jurisdiction. Celia, can we start with you from a tax perspective and tell us what you'd be telling the client in terms of managing the project across Africa?
Thanks, Peter. Yeah, I think maybe to start off, I think the most important message is the age-old one that Africa is not one country. And each and every country has different rules. And even if countries share the same colonial history or on the same region, it's still really important to consider the tax implications and legislation in each country separately, because there are differences in every country. And I know a few of our clients have fallen into the trap of assuming that similar provisions will apply when it's not the case. So I think one important consideration from a tax point of view is considering a centralized holding company for the group, particularly for the region. So it has both commercial and tax benefits to do that. From a commercial point of view, it makes sense to centralize the management of operations, making sure you can consolidate the results of the group from an accounting point of view, and it facilitates listing or disposal of the operations in future, should that be considered. And from a tax point of view, it should be able to allow for the tax-efficient repatriation of profits and, again, tax-efficient disposal in future. So typically, an efficient holding company jurisdiction would have a stable political environment, an established banking sector, no or limited exchange controls, a low effective tax rate, a wide treaty network with other jurisdictions in which operations are based that will allow for reduction of withholding taxes on dividends and other payments being made, and then also no or low capital gains tax on the disposal of shares. However, it has become more complicated recently to choose and use a holding company. The OECD's multilateral instrument has become effective also in a number of African countries. And one of the key provisions in the instrument is that you should not be using a treaty purely or a holding company purely to benefit from the tax savings afforded by treaties. There are specific anti-treaty shopping provisions in the multilateral instrument. So it's very important that you must also have a commercial reason for the jurisdiction that you are choosing. Over and above that, quite a few African countries have implemented what we call domestic anti-avoidance provisions. That basically goes a bit contrary to international tax practice and says, even if there's a treaty between us and another country, we'll only grant you the treaty benefits if, for example, more than 50% of your beneficial owners are resident in the other treaty country. So you may end up, despite there being a treaty, not having access to the benefits of the treaty. Also, more and more countries are demanding substance in the country that you set up a holding company jurisdiction. So long gone are the days of a brass plate on a door of an advisor or a professional firm. So it's quite important to consider all those various attributes before setting up a holding company jurisdiction. So maybe just if you look at the tax implications of the disposal or the acquisition, and I think George has touched on it, most African countries have rules pertaining to the sale of direct or indirect sale of shares. So if you're going to acquire shares, very important to consider the local tax implications, even if the sale happens at a higher level in the group. And I think it can become quite tricky if you dispose of a holding company that holds various subsidiaries in the group, because then you have to allocate the revenue and the profits amongst the different entities. And it's sometimes very difficult to determine what is the basis of that determination. So that's kind of something important to consider. And I think maybe just once that the group has been established or acquired, in all likelihood, there will be significant intercompany transactions between the head office or a central services company and the subsidiaries in Africa. You can have funding or head office support and technical services being rendered. And it's very important to note that all these transactions must comply with the transfer pricing regulations in the different countries, which is normally based on the OECD guidelines, as George mentioned, and that's based on the arm's length principle. And most African countries now have transfer pricing rules that also include documentation and reporting requirements. So whenever you have any intergroup transactions, it's important to consider what compliance requirements you have to comply with. These transactions are very often subject to quite high withholding tax rates, which may be reduced under treaty. So again, quite important to consider where you establish a central services company or a funding operation to make sure you can benefit from the treaties. And I think an interesting quirk that is quite unique to Africa, as far as I know, is reverse VAT on imported services. So many African countries have this provision that if a local company receives services from a non-resident service provider, VAT is levied in the hands of the local recipient through what we call a reverse charge mechanism. So the recipient must pay over the VAT to the revenue authorities, and there are different requirements to be met before the local recipient can claim such VAT as an input. For instance, in Zambia, the transaction must be invoiced through a local registered VAT agent to enable the company to claim the input. In Rwanda, you can only claim the input if a similar service is not available locally, and some countries just deny you the input irrespective. And as George mentioned, VAT rates can be as high as 18% in Africa, so that can add 18% to the cost of your operations without thinking about it. So maybe just to conclude, I think you asked about managing a project like this, and I think it is quite important that you use a central point of contact for a transaction like this, someone that has experience, a firm that has experience in the region, and that can oversee it from all different aspects to make sure that advisors in the different countries receive a proper brief, the right type of questions are being asked based on past experience, the inputs received are being reviewed from a consolidated point of view, because sometimes an issue may arise in one country that has an impact on other aspects of the operation. And if you don't have a central point of contact looking after that, you may not be able to address that issue. So yeah, I think that's me. Thanks, Peter.
That's really useful. And Celia, I always think it's astonishing that you look as young as you do, given your job as the head of our Africa tax desk, where when a client comes and says, I want to invest in 10 different African countries and I need the most tax efficient structure for doing so, and I want your advice in the next week, you're the one that pulls that together. And exactly what you said, you're too modest to sort of say it, but using our own expertise, George and others throughout our firm in Africa, but also pulling together our network of friends, that we call them, that we built up over many, many years. And you find that there aren't too many tax experts in many of these jurisdictions, and to be able to find them and get a response from them, and then to sort of pull this whole thing together in a sort of way that makes sense for the client. So it's optimally structured from top to bottom throughout all the African jurisdictions, I think is a real challenge and a very interesting piece of the work that we do, and an important piece as well. So thanks for mentioning that. Derushka, we're back with you. Can you tell us how you would manage this project from a competition law perspective?
Thanks, Peter. And I've strayed a bit in my earlier session just to showcase some of the differences and similarities in some of the jurisdictions. So I won't repeat any of that, but to say the following, and maybe firstly, to pick up on a point that Isaac raised, is just the importance of having this multidisciplinary strategy, because hearing him and how investor friendly this case study may be treated from a corporate commercial perspective, you've then got, on the other hand, a very interventionist competition authority who is looking to impose conditions and to do good for the country, protect employees, protect local empowerment. And so balancing that, and then to add the tax and all the other interplays with the different disciplines, I think you can't work in silos doing something like this in a cross-border transaction. So that's the first thing. The second is, Celia, I can't over agree, and I can't echo what you've said, that Africa is not a single country. For us, almost all the competition authorities on the continent are part of some regime, and they are a force to be reckoned with. They're devoting time, resources, expertise to merger investigations, and they're talking to each other. We attend conferences that are frequently hosted by authorities, where regulatory role players attend, the legal fraternity attends, and we all get to share in the developments and learnings. And authorities have MOUs and other collaborations and initiatives with each other. Merger investigations across the continent, they aren't just tick box exercises, even in a regime that's just popped up. They monitor what's happening on the deal in another country, and we getting asked more frequently, well, you're giving these conditions in this country, why can't you give them to us in our country? So you do need a holistic view, but you also need to do your homework in each country, understanding the similarities, the differences, the pressure points of the commercial transaction, holistically and from an in-country perspective. That's quite critical. Timing is a very big thing for us in competition, because the timing of each jurisdiction's investigation depends on what's raised in country. In a restaurant chain type acquisition, you may have participants to contracts in country trying to get protection through the competition authorities to extend those agreements and so on. And of course, the local importance around inputs in the food chain, as I've mentioned previously, is something that's always going to be looked at. So, having a holistic project manager, as Celia mentioned as well, who has an eye on all the filings, all the deliverables, really is key. And of course, some of the small points Peter, that can sometimes pose big issues in some of these transactions where, you need to be mindful of what your timing is like. So in Mozambique, there's a requirement that you must file within 7 days of concluding your agreement. I've mentioned COMESA has a 30-day timeline at the moment to file after you've concluded your agreements or after the decision to merge. And, from very early on, if you think that you can't adhere to these timelines, I do encourage engagement with the regulators. Even when it comes to filing fees, each country has different filing fees. In COMESA, it's 0.1% of parties' combined revenue or assets, subject to a cap of up to $200,000. And if you're making payments from offshore, bank charges and other inadvertent costs sometimes result in your fee being short, so the clock doesn't start running. And that can delay the timeline as well, so really monitoring big things and little things. I think the concept of ring fencing as well is something that we've grappled with from time to time, where, are you allowed to implement in those countries where you've received approval, pending keeping the businesses separate in other countries where you haven't as yet received approval? And I can say it is not obviously catered for in most countries. Eswatini is one of those countries that expressly has the provision where if you show on good cause and you demonstrate urgency, they can cater for that type of structure. But overall, I would say that authorities are very open to engaging. And if you've got time sensitivity, raise it sooner rather than later, and get back to basics. It's always good to get round the table, face-to-face or virtually, especially in the times that we find ourselves, to discuss urgency, get ahead of issues, and that really contributes to a seamless cross-border transaction type approval. Maybe my last point, I see there was a question raised on Section 18A of the Competition Act. If all of that is not enough to go through competition merger approvals across the continent, there is some moves in the works in South Africa to introduce another approval, especially with the purchasers of foreign vehicle outside of South Africa, to go through another approval in addition to competition approval. It's not yet in force. And of course, it will be interesting to see if it does have any effect on foreign direct investment. Certainly, the intentions are laudable to do great for the economy and to do great for public interest, but we'll have to wait and see what effect it actually does have on foreign direct investment and appetite more generally. Thanks, Peter.
Thanks, Derushka. And if Derushka sounds like an expert in managing these projects across Africa from a competition law department, it's because she is. Our competition law department do a huge amount of work across Africa, I think more than many of our other departments, and really are expert in terms of not just the South African filings, but across the continent. Isaac, can we come back to you in terms of managing the project, the African project, from a corporate commercial perspective?
Yes, thanks, Peter. I think I must first say this. Each deal is different, and how one approaches it will always depend on a number of issues, including whether we are in a bidding process or it's bilateral, whether the asset is distressed or it's not distressed, whether we are in a listed environment or not. But there are some commonalities that we often recommend to clients as to how best to execute on their deal. And the first one, obviously, is for us to assemble the right subject matter experts, depending on the target, the industry we are dealing with, and engaging our offices across the continent and our best friends across the continent to help us to execute on the mandate in a seamless manner that delivers value to client. To proceed on that, one thing that we normally recommend for clients is to do a high-level risk assessment before they dive on to aspects of the deal that may end up being wastage. To do a high-level risk assessment on the deal to identify if there are execution risk on the deal, and if so, whether those can be navigatable, including whether they can be navigatable through creative structuring, or if it's a no-go. We are obviously keeping an open mind and being pragmatic. We want to be solution-oriented at all times. But if something is a no-go, we will advise the client early on to avoid waste of executive time and waste of costs. And things that may very well mean that the deal is a no-go may very well be things that are indicated earlier on FDI restrictions per jurisdictions. Other jurisdictions have very hard restrictions on the type of businesses that foreigners can go into. So there are those businesses that are reserved strictly for citizens. Botswana has got that type of regime, Ethiopia and Ghana. So one is to first identify if the business that the client is keen on falls within those excluded businesses. The second one is the issue of land tenure, particularly in hotel businesses, which is our case study here. Other jurisdictions have a complete bar on foreign ownership on land, whereas others have only leasehold for a specific period, ranging from 20 years to 30 years, and others have up to 50 years. So if the client's long-term strategy is to have a longer tenure and that jurisdiction doesn't serve their strategy, then again, there it may be a no-go. Again, the other thing that we also recommend is to do a high-level anti-corruption assessment on the target, including the key partners that the client is aiming to do a deal on. This is more important for multinationals considering implications under the FCPA and other anti-corruption legislation. So you would not want to be caught in the mix of scandals, having acquired an entity that later on becomes embroiled in scandals of corruption. So once we pass through that early on assessment and we've got a green light, then we will recommend that a comprehensive due diligence be undertaken. And there, obviously, we are looking at typical things of reviewing contracts that are the underlying foundation of the business to check if they've got significant lifespan, and if not, how we deal with them, whether there are restrictions, including change of control, and how we deal with them. And at the end of all that, obviously, that the outcome of that due diligence will often inform how we structure the transaction, whether we do it in a form of the traditional sale of business or sale of shares, whether we adopt a statutory measure, or whether we adopt other mechanisms provided in the Companies Act, including scheme of arrangement if necessary. So that is how generally we approach transactions of this nature, Peter. And even throughout the process, we always keep an open mind to bring across whatever modifications that may need to be brought in the structure. Obviously, keeping in touch with the tax team and the competition team to ensure that ultimately the structure we work off is the structure that can work. So let me pause here, Peter.
Thanks, Isaac. That was really, really good, really useful. And as you and Derushka and everyone said, you just cannot do these kind of jobs in the silo. You just can't do it. You just have to work across the different disciplines. George, you are going to have the final word. Can you talk to us about the East African management of this transaction?
Yeah, happy to, Peter. I completely agree with the comments that are coming out of this discussion, from a tax and corporate perspective. And the same, still do apply, when the projects are happening in East Africa. Because one of the common threads, within the countries in East Africa is the increased aggression with which the tax authorities approach taxpayers. And it becomes increasingly more important to then handle the tax aspects of, either the acquisition or a disposal, and to handle it very carefully. One of the projects we worked on a couple of sometimes back was an issue where the Tanzania Revenue Authority sought to attribute more value on a disposal to the Tanzania entity, and by virtue of the client having very clear contracts and valuations of each particular entity, it made that discussion very, very easy. So you can see it can easily get so complicated depending on how it's managed. And so it makes sense to have a proper advisor who just looks at the whole project and advises appropriately. And my second comment and last comment is the tax authorities in this region are doing very well in reaching out to tax authorities outside this region, and there's a lot of communication and exchange of information. So from a transfer pricing perspective, in terms of any transactions happening between, the entity in either Kenya and, Uganda or in an entity elsewhere, the taxpayer should be aware that the tax authorities are likely going to reach out and get corroborating information. Yeah, that's it.
Thanks, George. I think it's really good. I see we are 1:05, so just after our allotted time. So I'd like to thank all the panelists and really thank all of our viewers today as well. I hope you got value out of that, and thanks to all for participating. Cheers all. Bye.
Cheers all. Bye.
Yes.